listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for joining us today. I'm really excited to have this guest with me. I think we did an interview 4 or 5 years ago with him, but he's Larry McDonald, editor, founder of the Bear Traps Report. And since I've been following gold stocks for years and years, I have to say that Larry is one of two people these two people are just absolutely fantastic market timers when it comes to the gold stocks. And Larry does a lot more aside from the technical side. He focuses on all those other things. And Larry, I know that you're really bullish on the gold stocks right now because they're extremely oversold. You like the setup, the potential for the Fed to shift. But, larger picture, I just want to step back for a second and talk about that, because looking at the chart, if you're just basing it on technicals and you're looking at a chart of silver, a long-term chart, it really looks terrible. It's rolled over badly. Gold has a potential double top in the chart, and these are long-term charts. So if you were just looking at the charts, and I know your charts look the worst when markets bottom, but if you were just looking at the charts, the market message would be the Fed is going to be able to get through this recession. Maybe it's only going to be mild. Maybe they're not even going to have to pivot at all, or it's going to be a very mild pivot. I mean, to me, that's the message that the technicals for gold and silver are sending. I mean, what's your view about that? And delve into the Fed having to shift a little bit more. What are your thoughts on all those things?
Well, the technicals really deteriorated when the Fed started leaking this 100 bips, and that 100 bips, 100 basis points. Right now, the 6-month T-bill yields the same as the 10-year Treasury. So that is your big driver. The problem is the systemic risk around what the Fed is doing globally is off the charts compared to any others. There's nothing like it. Any hiking cycle in the history of humanity. We've never seen a Federal Reserve with this much accommodation withdrawal on the table with the global systemic economic backdrop this ugly. And that is, I think, an incredibly bullish dynamic for gold. Now, technicals, I'm looking at this 1715 level, right? We have bounced off of this level 3 or 4 times in 2020, 3 more times in 2021, 1 more time in August of 2021. So it's a dynamic where I think we're on very, very firm support. And now you're coming into a Fed meeting. We're going to send out the numbers, but all you did the last 15 years, if all you did was buy the gold miners into Fed meetings, I'm going to get you the returns, but I think your net returns are like 15, 20% each time. Because what happens is the Fed overpromises. They run into some systemic problem globally with the global wrecking ball that is the U.S. dollar, and then they get about 16 or 17 phone calls from finance ministers around the world, and there's your setup for a softer path, and that's where the gold miners make a reverse.
Okay, so I mean, with respect to the sheer size of the shift, because I mean, there's one. I mean, I guess a quick question for you: when they shift, do they stop hiking? Do they immediately have to go to cuts? Because that's my thinking is, okay, well, the reason they'll stop hiking is because they're hurting the economy, which means they need to ease policy. So, I mean, do you think that the shift, they're just going to try and stop and not do anything for 3 or 4 months, or the shift is going to include like an immediate turn to having to ease policy some way.
Okay, so Elon Musk is on the tape today talking about inflation and the data that he's seeing. He's got a lot of really good live data. Is pretty telling. And the move in copper, or the big three, copper, oil, and rates, we've only seen this kind of 40-day move in copper, oil, and rates. We've only seen this in the last 40, 50 years, maybe 2 or 3 times. Lehman, COVID. That's the neighborhood that we're in here. Just think about what's happening. We're having a 25 to 30% move down in oil and copper inside of 40 days with a 60-bit move in yield. That tells me, along with Philly Fed today, the lowest in 35, 40 years in terms of new orders, ISM data, the warnings from Walmart, the warnings from all kinds of companies, Zuckerberg talking about recession, Apple warning, Microsoft warning, all both on job cuts or job, it's no question that we're in recession. And so, therefore, the Fed stops, then to what you're alluding to is very important. The Fed stops and basically has to take the quantitative tightening plan off the table. That gets you a big rally in gold and silver. Now, then what happens is you've got trillions of dollars still in growth, growth stocks. You've got the baby boomers have about $57 trillion of wealth. And still, if you look at the S&P, it's still 40% tech. If you look at the whole tech picture, because you've got the tech sector inside of the S&P, you've got consumer discretionary, which has Amazon and Tesla. So the whole point is, and communications has tech in it. So you've got 40 to 45% of the S&P in tech. So that's a tremendous amount of assets that's in what I call financial assets, bonds and tech stocks. It's trillions of dollars. And when I was coming up in the business, when you had what I call sustained inflation, when inflation normalizes at 3, 4, 5, 6%, which I think is going to happen, so the Fed stops, inflation comes down, but it's sticky because of supply chains, because of reshoring, 20 things. The power of labor's much more powerful now. Those are the big three. Labor unions across the United States have 1,000% more than they were 3 years ago. So inflation normalizes at this higher plane, 3 to 6%, and then you have the S&P 500 for materials and energy combined is only 6.5%. When I was coming up in the business, materials and energy were 20% of the S&P because you had this inflation normalizing at a higher plane and staying there for long periods of time. And because if you're sitting on $1 million and you got, it's one thing if you got inflation for 1 year, people can adjust, people have to adjust that over time. But if inflation is 5 to 9% over 2-3 years, and it doesn't really break that range, every day, every minute, every second of that type of dynamic, wealthy Americans, wealthy people around the world are going to be moving their dollars into hard asset plays. And so we're not there yet because we've only been dealing with inflation for 12 months, and nobody thinks it's sustainable. Just look at 5-year forwards, look at break-evens. Nobody's bought into a sustained inflation regime.
Larry, then what's going to be the signal? What's going to be the market signal that inflation is going to normalize much higher than people think, above the 3-4% that you're talking about? Is it gold breaking out? Is it something else?
Well, the first thing you're going to see is when the Fed gets inflation down to 6, they're going to celebrate that like Kool and the Gang in 1980. They are going to be doing Michael Jackson moonwalks, and the media is going to celebrate it. And so they're going to celebrate this first move down in inflation, and that will justify them taking a slower path And so that gets you the first leg of this rally. And to your point, you're making a brilliant point. Like, okay, we can get a counter-trend rally, but it's sustainable. And inflation, like I said, the secular forces in inflation that are different now than they were 3 years ago are the Europeans, everybody's fiscaling up to get out of this energy mess, right? So you're actually making transfer payments to individuals. In the United States, we did a lot of that last year. But it's like, what's the signal? It's more like, I'm making an educated guess here that with supply chains, with reshoring, with the power of labor, you get a higher normalization of inflation. Signals we're going to look at, obviously we're going to look at bonds, we're going to look at copper, we're going to look at oil, we're going to look at ISM, we're going to look at economic indicators. But as the economy slows down, the supply of metals on the planet Earth is about $3 trillion of CapEx that's come. If you look at the 2014 plane for CapEx, if you took the 2014 numbers and you extrapolated them to today every year, we're in a $2.5 to $3 trillion CapEx hole. So the world is massively undersupplied of energy, commodities, and so that's another force. That's force number 4 of sustained inflation. So you have reshoring, supply of labor, the power of labor, reshoring, and then you have this metals, oil, and gas dynamic around supply, and then you have supply chains. So you have like 4 colossal forces for higher inflation, sustained inflation, that weren't around. Remember, in 2019, inflation was, and we were in a deflationary spiral because of technology and aging population, the whole thing. Those 2 things are still around, and they're big forces. But now we're up against, 4 big other forces that should keep inflation in that 3 to 6 range for at least 5 years.
Okay, I got 2 more questions. I'll separate them because I want to get your thoughts on both. But the first one is, when does the psychology of Joe Sixpack, when does it change from I'm really mad about inflation, damn it, to holy shit, we're in a recession, I'm going to lose my job, I'm really in trouble here? When does that shift, and how will that? Is the Fed waiting for that political shift just for the average population that's very upset about inflation? Or, tell me how how we can measure that and how it's going to impact Fed policy and how quickly.
Yeah, so that's one of the reasons why the gold trade is so hurting right now. Is you were coming out of this supply of labor dynamic where, if you look at the JOLTS data and the amount of jobs that are available versus people that are taking the jobs. So you had this massive labor shortage, and you had this really hot economy a year ago because there was tons of fiscal. We ran back-to-back $3 trillion deficits. Remember during the Obama years, we were doing $1 trillion deficits per year after Lehman, 1 to 1.3. I think the highest of them was 1.35. Now we did after COVID back-to-back 3. It was basically 3 and 3, or a little bit more than 3 on one, a little bit less on the other. So we did $6 trillion of deficit spending, and that gave us a ton of people that didn't have to go back to work, and they were just sitting on the beach. My wife and I am a high net worth / high income person, and we received $1,800 last summer from the U.S. Treasury. They just deposited in our bank account. Absolute insanity. So that kept a lot of people on the sidelines. Now what happens is, as the economy weakens, and we've had at least 200 major companies warn on, whether it be Coinbase or Microsoft this week, and just Apple, they're all warning on jobs, right? And so that data is not in the jobs data yet. There's no question in my mind we are going to be negative 100,000 or more jobs by October, based on all the internals that we see. And so what's crazy is March of 2000, the United States did 430,000 jobs, right as we're going into one of the worst recessions to ever hit the United States. So a lot of times you get like these hot jobs numbers where, like you said, there's a lot of people on the sidelines. There's an economic shock. They're like, oh, I better go get those jobs. So you have a whole bunch of millions of people that were on the beach, not in the labor force. All of a sudden you have an economic shock coming, like, oh, I better go get those jobs. And so all the jobs available that appeared so plentiful, then the economic shock takes a lot of those off the table. The people come in to the labor force as they came in the June data, and that is just a very, very stark, dark warning sign. So if you look at today, the move in unemployment claims, and we have a chart we can send you, but it's like if you actually measure the move relative to the last 40 years, it's in deep recession risk territory. And then you have, like I said, 6 month versus 10-year, that's in recession territory. So there's 30 things, and we're basically in recession. And so the jobs data is the last thing to go, but the Fed is stuck, basically a false, stale bread narrative, because listen, when I know I'm on the Hill a lot, and when the President of the United States and the press secretary of any administration, whether they're Republican or Democrat, when they say that the jobs are fine, when they say the economy's strong, and Powell's on the Hill during the same week, he has to basically toe that line, and that's what he's been doing, and that's been crushing gold, because Powell's out there selling the entire world that the U.S. economy is going to be, we got a good chance of a soft landing, stocking up, strengthened labor market. And so the underlying shift that is so clearly near us hasn't been admitted to yet. In other words, they're in a stale, fake narrative. He doesn't want to embarrass his president. And by the way, I wrote about this in my book, Colossal Failure of Common Sense. It's a New York Times bestseller. It's now in 12 languages. But Hank Paulson and Bernanke were doing this for Bush in June of 2008. And I'm not saying this is an 08 situation, but it's similar in the sense that you have a big economic drawdown that's in the process of going through. And Bernanke and Paulson were talking up, jobs in the first, second quarter of 2008. And so we see these things all the time where central bankers get stuck in a false narrative. During that period, gold gets killed because they're holding up short-term rates, and the dollar's strong. Why do you need gold, right? So that creates a capitulation setup that should be very tradable and very, very profitable.
Larry, what happens later this year if we see the stock market roll over and trade to new lows? I mean, obviously the Fed funds futures would probably be pulling cuts into the immediate future, but I mean, where are people going to move money in that scenario where the market rolls over, everybody knows we're in a recession, it's official, but inflation, people don't think it's going to come down to 3 or 4% or 2%. Again, I mean, is that like a severe stagflation scenario? What does the Fed do? Are they going to continue to talk tough about, getting inflation down if we're in a recession and the stock market's made a lower low? I mean, it just seems like there's really no good answer at that point.
Yeah, that's people think that people think recessions. People think you can't have raging inflation in a recession. What's scary? There's a whole class of people in America and in the finance community globally. And I've done 140 speeches in 16 countries, so I've met a lot of these people. There's this whole group of people, maybe 30 to 40 years old, that they don't they literally don't believe that you can have inflation in a recession. Like, they don't believe it. They never seen it before. And this was the case from 1968 after Vietnam War. You know, war issue, you have pandemics throughout the history of the U.S. economy that create sustained inflation. And so from 68 to 74, the S&P had like 4 different moves up and down 20, 30%, but it was flat. And that's exactly what we're coming into, because remember, the boomers have about $57 trillion of wealth. The millennials have $5 trillion. And the reason this is so important now, demographics haven't mattered at all the last 10 years. The boomers now are about the oldest boomer is 80 years old, right, in America. The average boomer is 67, okay? So 10 years ago, 12 years ago, the average boomer was 57, 55, when Lehman went down. Now the average boomer, and when COVID happened, the average boomer was 65, right? So you've gone, and now you're 67. But the average boomer, this is $57 trillion. So this group of people got punched in the face with Lehman, got punched in the face with COVID, and now they're, like you said, now they're dealing with a Powell that's not really, promising to have their back. And it has to deal with sustained inflation. So that just gets you much lower stocks relative to past cycles. And that's why, these rallies can't be trusted. You can trade them, and it's just like any bear market rally. But the supply of Apple stock and Tesla supply up here is so enormous. And people, in a bull market, people want to make money. In a bear market, people want their money back, especially a 67-year-old that is, approaching 70, and the Powell doesn't have it back. So that's to your point. Then you go lower on the S&P, you're somewhere around 3,000 to 2,800, a year from now, and that's going to push more money into hard assets.
On that note, Larry, thank you so much for coming on. Before I let you go, please tell our listeners about the Bear Traps Report, how they can follow you on Twitter, and also how they can subscribe to the Bear Traps Report.
Well, it's not really a retail product per se. It's mainly institutional investors. So we have about 650 institutional investors in 23-plus countries. So you picture your hedge funds, your mutual funds, your pension funds. We have a live chat on Bloomberg, and we have it's kind of like, years ago we used to do we would do ideas dinners in New York, and it was it was always a great experience because you bring in 3 or 4 hedge fund managers, you bring in some advisors and a couple of pension people, and you get share ideas, and you have an argument about bull and a bear. And so we're doing that real time and live. Now, for the retail investor that's pretty sophisticated, we send a recap of this. We're basically giving people a lens on a buy-side conversation. And so it's not so much a newsletter per se. It's more like, what are asset managers talking about today? Forget about the sell side, their acts, right? The sell side research is horrible, and the banks are always trying to sell something and move something. What we're doing is we're giving high net worth investors that are sophisticated minds a lens on a buy-side conversation. So that's the beartrapsreport.com. And we're at ConvertBond on Twitter. And, I really appreciate you taking time to have this discussion.
Oh, well, it's all my pleasure, Larry. My listeners and I really appreciate it. And I hope we can do this again in the coming months.
Well, I think, I think the last time we did this, we were, what I've noticed is there's a lot of timing around this call, the fact that we're doing it now near a Fed meeting, and the fact that emerging market risk is ripping. Obviously, bank risk in Europe is near Lehman levels in some respects. Well, definitely near COVID levels. And so the fact that we're doing this call speaks to, I think, a possible shift. So it's a pretty good indication that this is just one of many things that we're looking at, and I appreciate the conversation.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.